Joining us now is billionaire businessman Mark Coombs. He's the CEO of the Ashmore Group, a London-based emerging markets investment manager. Mark, it's good to see you. Welcome.
Good to see you. Thank you for having me.
So you're paying close attention to this debate?
Yeah, we have to.
Why?
Everybody cares about what happens to the largest economy in the world and what's regarded as a store of value. And so all emerging economies care very much what happens within the U.S. and how their risk is priced relative to the U.S.
I mean, the U.S. dollar had a really weak start to the year, the worst in decades, actually. Do you think there has been any discussion about reliability, safety of the dollar, or is it just an unwind of positioning on certain trades?
It's a bit of both. There's no question that the U.S. dollar has had a very strong run over the last sort of 9-10 years, and people have been sucked into that. And there's a massive sucking sound of capital moving from the rest of the world into the U.S., together with fiscal expansion here, has meant that there's been a huge amount of money gone into financial assets in dollars. So that's definitely happened, and people regard that as important. In terms of what they're thinking in the future, there's definitely a feeling of where do I put my marginal unit of currency? Where do I go from here?
What is the answer to that?
The answer is a lot of talk, and we'll see what really happens over the next 6 to 12 months. Well, our business, as you know, is investing in emerging economies, and we do a mixture of things. So we buy fixed income, equities, and alternative assets, and some of those are denominated in local currency. And obviously, in terms of the way we're thinking about things at the moment, we're much longer local currency exposure than we were a year ago.
But to the extent that marginal dollar does find a different home, is it because growth prospects improve ex-U.S. or because they're trying to sniff out instability here?
I think there's two things going on. The growth prospects have been better ex-US for a while in terms of emerging economies. I mean, you've got to pick the right ones. I mean, the little ones tend to suffer a bit, but the bigger ones don't do that. In terms of instability here, yes, there's nervousness, obviously. The core reserve currency of the world, if the institutions are challenged, there's concern about that. I think it's a mixture of things at the moment. I think a lot of people are really saying if we're starting from a long dollar position, the MSCI Global World Index is now 70% US equity. Would you start from there? And when you go, oh, wait a second, and is there risk to Fed independence monetary policy? Oh, where do I go from here? So I don't think there's a whole big, we got to get out of the US, ciao, baby. But it's a little bit more, what do I do with my marginal wealth as I create it, and where should it go? And we're seeing that, I would say globally, actually, from Asia in particular, and from Europe, where they've seen their relative attractions of Europe improving from where it has been, and a little bit here. Here it's mostly conversation.
When you think about cautionary tales where an otherwise robust or promising economy got derailed by a lack of central bank independence, who do you think of?
Well, yeah, over the last X years, there have been a few of those. I mean, I guess one of the most recent memory ones is a very large economy with a tremendously strong demographic and great geographic location in Turkey, where there was incredible political interference at one point with central bank and generally with economic management. And that certainly created big problems, very high inflation, naturally very weak currency, and a pretty significant recession at one point. And so that's a cautionary tale. But if you go far enough back, you've had the Brazils in the past, you've had a series of other countries.
Yeah, UK, as I mentioned earlier.
Oh, yeah, we've definitely had it there.
You've had it there. So
we might get it there again.
Oh, really? Are you worried about it? Independence?
You've always got to be concerned. Not about Fed independence, but about the way policy is managed generally. You've always got to be concerned and make sure that you understand that you're following basic policy rules and that the independence of institutions is robust. To be fair to the UK, there's no particular threat to the independence of institutions at the moment. But you've got to be concerned about economic policy everywhere.
Populism. So how are you approaching emerging markets now, given the tariffs? Does that change investment cases for certain markets?
It does. Our view on emerging markets generally is we've always liked the ones where we see them creating their own domestic yield curve, creating their own domestic capital market and trying to expand that with a rules-based set of governance and with strong demographics. So what that means is we tend to try and do the most that we can in the larger economies, and the smaller economies are looking for a higher risk-return trade-off. I think at the minute, you then look at what's happening in terms of tariff, and which is a tax on the consumer, where it's going. And our view there is that we like the economies where they have bigger domestic economies already, where they're going to grow in terms of their natural domestic consumption, but also where they're thinking about, well, I don't just have to export to the US. And I think what this is already beginning to signal what's happening in terms of this tariff conversation, and we still don't yet know where it's all going to finish, so the data is yet imperfect, is much more intra-EM trade. And what I think we also might see is more EM to Europe trade, depending on what Europe ends up doing with tariffs, and I suspect that will help Europe in terms of the cost of goods. And in fact, if anything, maybe a little bit of a deflationary
pressure. Is that China?
Pressure.
Do you count China there?
China for sure. But all of EM will be looking at where it's going to export, and it's going to go intra-EM, and it's going to go to Europe.
And who's the best example of what you just said? India?
India, yes. I think you're going to see a fair amount of Chinese goods certainly move to Europe. There's already a connection there, and I think you're going to see more of that. Remember, China has a problem. So it has a domestic consumption situation that isn't as strong as they would like. They would like more growth. They have almost certainly overcapacity in a lot of industries in manufacturing. You know, they're the largest manufacturer in the world by far. They're bigger than numbers 2 to 10, so they're enormous. And their manufacturing goods have got to go somewhere. And if at the margin less of them come here, and they won't all not come here, but if at the margin less of them come here, they've got to go somewhere. They will try, and certainly you'll see some consolidation in their manufacturing base, I expect. You'll see some form of productivity gain. But it's not all going to disappear in a hurry, which means it's got to go somewhere. And you've already seen their data is beginning to put much higher exports to Asia.
Right.
That isn't all transshipment here. Some of that's going for domestic consumption there.
It's like trying to hold back water, right? All those goods.
Yeah, they've got to go somewhere unless you shut everybody down. And then you have a big political problem at home. If suddenly you've got everybody's out of work because you've shut down your manufacturing base, and China's not going to do that. They're going to consolidate. They're going to try and become extremely productive with technology. That's why they're pushing the whole AI thing and their whole sucking people into what they do in AI. But they're going to continue to be deflationary in terms of manufacturing goods for a while, I think.
Well, Mark, we certainly appreciate you coming in and talking to us
pleasure.
from the Ashmore Group. Thank you.